I've had a lot of people ask me, hey Chris, these interest rates are so high. Are we going to see something like 2008 or is it going to be something different? Well, at the Real Estate Rule, this is what we're going to get into. So, hey, stay tuned and let's get into it. So, 2023, interest rates are up. They are around 7%. And people ask, hey Chris, is this like 2008? Well, if you look at the rates, back in 2008, they were 6.03%. Our rates are a little bit higher today. The difference is our prices are higher. Now, the reason why 2008 went down the way it did is because of stated loans. Ninja loans, no income, no jobs, no assets, no problem. This is what they did. They were giving people loans that should not be getting homes at that time. Somebody can make $10 an hour and they'd give them a $500,000 loan. And lenders would say, hey, it's just gonna go up, just refinance. But you know, like anything, whatever goes up must come down. And that's exactly what happened into our market. Now, 2023 is a little bit different because we didn't have the financial meltdown that we had 15 years ago. So we are going to see the market go down, but we're not going to see it down like 50, 60%. I speculate we'll probably see 30%, and I think that these homes that are $500,000 in our area, 30%, those homes are going to be $350,000. Now we have to find the happy medium right in between. So when people are looking for a home right now, not a lot of buyers are looking, and lenders are creating programs right now that says, hey, if interest rates drop, we are going to actually refinance you for free. So I think that is kind of unique situation. I've never seen a lender say, hey, buy a house with us right now, and if the rates go down, you can refinance. It won't cost you a dime. Now the only thing is you're going to be paying a little bit more, but I really want you to take a look at your finances and see if you can afford it, because you know, if you're going to pay for rent, which can be up to $2,500 a month, that's $28,000 per year, $20,000 to $30,000 per year at $2,500 a month. Well, you know, at $2,500 a month, you can probably afford around a $300,000 to $325,000 house with a good down payment. One thing I want to say is interest rates. You know, people say, how high can these interest rates get? In 1981, interest rates were at 16.5%. You know, sometimes I hear like my family who bought a home in the early 80s say, hey Chris, when I bought my house in 1981, we used our RV as a down payment. Those are called wraparound loans. And so I don't think we're gonna go in that kind of scenario, but we got so creative in the early 80s, we were using people's vehicles and their assets, not just money, as down payment. The craziest thing that I've ever seen in my career is I had a gentleman come to me and say, hey, do you take gold bullion? I had to check him, like, gold bullion is it's gold, it's straight gold bricks. And I had to check with the title company and say, can we take gold bullion? And no, we can't, because you have to go to an exchange to get it. But I was just like, where does someone get gold to buy? And then looking at these rates, I can tell you where, because of these rates. So I think it's gonna be really interesting. We're gonna have a lot of creative financing coming up again. We had creative financing between 2001 and 2005. And 2005 to 2008, we had a lot of creative financing, but it wasn't ninja loans between 2001 and 2005. After that, we created loans where they were called pick-a-pays and Nehemiah programs. What a pick-a-pay was is you can do a 30-year fix, you can do adjustable, you can do a 3-year adjustable, or which everybody did was the interest-only loan. So one thing that was bad about that loan is you bought your house and you're only paying the interest on it. And so the rest of your principal was getting added on to the back of it. So you bought a house for $350, within 5 years, your $350 house is now you owe $360 against it. If you're not putting any principal down against your home, you're never gonna own it. And I think that's what a lot of predatory lending was at that point. Now what we did is we called a Nehemiah program, was when you bought a house, the government gave you $8,500 back. After closing, they gave you a check for that. So I might see that come back. We're gonna have some creative financing that's coming through. Right now, the only thing that I heard is, I talked about this earlier, is where if you buy a home and the rates go down, you can refinance for free. But what if the rates don't go down? You know, February 1st, we're supposed to have another rate hike. And so it's going to be really interesting to see what happens. We're really trying to halt inflation. And just this morning, you know, the Fed said, hey, our government limit is at its rooftop of spending. We've hit the ceiling level. So when that happens, we increase rates again to hopefully drop inflation. And I believe that we are here. We didn't have 9/11 this time around, but we had a pandemic. And I believe that we are feeling the economic pressure. And when our backs are against the wall, we always increase interest rates. And so it's very tough for people in the industry, vendors, brokers. It's tough for anybody in the service market. So we're really gonna have to tighten our belts in the next 24 to 36 months. And we're really gonna have to live under our means, because if we don't, we're gonna go into a point of a recession like we saw in 2008. And 2008 is just where these interest rates are coming. We're a little above we were at 2008, but the difference is a lot more people have equity in their homes this time around, and we're not going to lose as much because people got low interest rates in the last few years and they don't want to move. They don't want to move because their payment is so cheap. So it's going to create a frenzy with the investor, and if you're looking to buy a home, it's going to keep prices a little bit stable. So that's good and bad. It's good for the home seller to get their price, and if they want to go out of state, they can sell. It's bad for the buyer because now they're going to pay a little bit more, and we'll see what happens. Thanks for watching. Hey, make sure you subscribe, like, and follow. And if you have any questions, make sure you drop it in the comments.